Okay, so let's try this out. A company that uses the periodic inventory system overstated its beginning inventory but correctly stated its ending inventory. What will the effect of this error on the financial statement at the beginning of the period? So the beginning inventory was overstated. So correct. Let's say the beginning inventory was going to be like 200 plus let's say purchase equal 100 minus the ending inventory. Let's say it's like 100. So then the cost of goods sold um, would be 200. But then this is the overstated amount, overstated. So like it overstated how much the beginning inventory was. So 300 plus 100 minus 100 equals cost of goods sold 300. So the cost of goods sold is overstated because the correct amount is 200, but the overstated amount because in the beginning inventory is overstated. The cost of goods sold is overstated. The net income um, cost of goods sold is an expense account. So like if the cost of goods sold has been overstated, then the net income is understated. And then if the net income is understated, then that also means that the retained earnings is also understated. As so, the stockholder equity will also be understated. The current assets, on the other hand, um, called understated. Well, it says that the ending inventory is correctly stated. So that means the current assets are also correctly no effect. So like the purchases most likely will also be no effect because that's also correct. The working capital, current assets, current liabilities, no effect, no effect. Okay. Let's see. So the arrow was the beginning inventory. Cost of goods sold. Just this. So let's try another one. A company mistakenly understated ending inventory by understated it by 25,000 in a year, but verified the correct ending inventory was reported in the following year. What is the effect of this on the total net income for 2 years combined? So like let's say the beginning inventory was 30,000 and purchases were 10,000. And then the thing is they understated it by 25,000. So the correct amount should be like 30,000, let's say. This is the correct version. But the understated amount was 30,000 plus 1,000, 10,000. It was understated. So, like, let's say they actually put it as 5,000 instead. So 30,000 plus 10,000 minus 30,000. So, like, the correct cost of goods sold should be 10,000. But because it was understated, 30,000 plus 10,000 times 5,000, the cost of goods sold was actually what they put the understated amount because of the ending inventory being understated for that first year, but verify the correct ending inventory. So then the cost of goods sold was overstated in the first year. What is the effect of this on total income for 2 years combined? First year. So the cost of goods sold is overstated. It's saying that there's more expense than there is. So the cost of goods sold is overstated. So because the cost of goods sold is overstated, the net income is understated. And then the retained earnings is understated. The stockholder equity is understated. The ending inventory has been understated. So the current asset will be understated. But the purchases has no effect. So if the current assets was understated and there's no change in the current liabilities, the working capital, so like for example, let's say the liability is 0, just to make it easy. So like the correct amount of working capital if the current assets was correct, let's say the current assets, the ending inventory is understated. The current asset is understated. So like for example, let's say the current assets was 100,000. So working capital, the current assets at the correct amount is 100,000, but it's the current assets have been understated. So the working capital is actually like 70,000 minus 0. So the working capital would also be understated. And the current ratio would be understated as well. So let's try another one. If a company did not record the purchase of inventory or did not include this item in the ending inventory balance, what is the effect on the financial statements? So the company did not record the purchase of the inventory. So like the correct amount should have been, let's say the beginning inventory is 1,000, but they did not record the purchase of inventory. So like let's say inventory was 800, the correct amount was 1,000 purchases, and then let's say ending inventory 500, but did not record. That's the error. So like instead they only reported 800 when shipping 1,000. So 1,500, 1,300. Alright. So that means that cost of goods is understated. Okay. Because the correct amount should have been 1,500, but because they didn't record the purchase, the cost of goods is actually understated, and it's showing 1,300. And because cost of goods is an expense account, if the net income is understated, that means if the cost of goods is understated, if the expenses are understated, the net income is going to be overstated. It's going to show more net income than there actually is because the expenses are understated. And if that's true, then the retained earnings and stockholder equity will also be overstated. The current assets, on the other hand, the ending inventory, because the purchase was not included in the ending inventory balance, so then the ending inventory would also be understated. Okay, and then the current liabilities is also understated because the purchases is understated. And if both the assets and the liabilities are both understated, the working capital most likely would also be understated. Okay, and the current ratio is understated. So the inventory is understated. What does it affect on? Net income is unaffected. Really? Okay. Well, so like we'll have to like learn this a little more. But essentially, I guess it balances itself out. Beginning inventory. Okay, well this one's kind of weird because like the purchases should be included in ending inventory, but it wasn't, so like balances out. So nothing. So net income, the inventory itself is understated, but the net income is unaffected. Let's try another one. A company uses a periodic inventory system. $100 purchase is not recorded in the purchase account, but is included. So the beginning inventory is not affected, that's true. Purchases have been understated by 100. Is not recorded in the purchase account, but is included in the ending inventory. So ending inventory is not affected. Cost of goods understated, overstated. Okay. A company uses a periodic inventory system. $100 purchase is properly recorded in the purchase account, but it's excluded in the ending inventory count. Okay, so $100 purchase is properly recorded. So like the beginning inventory, let's say, is 1,000. This is correct. So 1,000 plus is properly recorded in the purchase account. So like the correct amount is this, but it's been excluded in the ending inventory count. So like so this is the correct amount. But excluded in ending inventory. So like 1,000 plus is probably recorded, but then in ending inventory wasn't recorded. So this would be what it would look like if it was excluded in ending inventory count. So 900 and 1,000 plus 200 minus 1,000. So the cost of goods sold is going to be overstated. Okay, it's overstated, but it's excluded. It's properly recorded in the purchase account, but it's excluded in the ending inventory account. Well, the cost of goods sold is overstated, so that the expenses are overstated, so the net income is understated. The ending inventory is excluded in ending inventory. Current assets also understated. Purchases has been corrected, so there's no effect on the current liabilities. Current assets understated. So working capital is overstated. So beginning inventory is not affected. Purchases is not affected. Ending inventory is going to be understated. Cost of goods is going to be overstated. Income is going to be understated. So, like, you guys see how to do this? And apparently there's accounts payable. So let's try to see this one. See how to do this one. A company uses a periodic inventory system. $100 purchase on account is inadvertently reported in the purchase account as is 200. There's correctly included any account as 100. So like, let's say there was like 200 beginning inventory. So 200. So like, if it was correctly recorded, it'd be the 100. But it's recorded in the purchase account 200. There's correctly included in the ending inventory count. So ending inventory count has been correctly recorded. So it would be 100 and 200. So the cost of goods sold is overstated. Cost of goods sold is overstated. Net income is going to be understated. Retained earnings will also be understated. The ending inventory is no effect. Purchases is going to be overstated. If the current liability is overstated, working capital is going to be understated. So beginning inventory, there's no effect. Purchases is going to be overstated. Ending inventory, there's no effect. Cost of goods is going to be overstated. Income is going to be understated. And the accounts payable is going to be overstated as well. So a company uses a periodic inventory system. A company incorrectly records inventory items purchases that were not received by the company's warehouse as of the last day of the most recent reporting period. Items were purchased under FOB, therefore they were not legally owned by the company on the period ending date. Cost of inventory purchased was $100,000. The company incorrectly records inventory items that were not received. So they're overstating the inventory. So like, let's say they had like 100,000 in beginning inventory, and then they recorded 150,000 in purchases, and the ending inventory is 50,000, for example. That's the correct. That's the correct one. That's the correct amount. But like, because they incorrectly recorded was 100,000. they should have reported 50,000 instead of 150,000. Cost of inventory purchase was 100,000. So 200,000 and 100,000. So the cost of goods sold was understated. And then because cost of goods sold is expense account, they understated the net income, so the net income, the cost of goods sold would be overstated. Ending inventory is correct, so no correct. Purchases has been understated. So because the current liabilities is understated, working capital will be overstated. The company balance sheet reports the following balances at the reporting period. Current assets 600,000, current liabilities 300,000. Oh, sorry. No, this is incorrect. So the correct amount should have been 50,000. They reported 150,000 when it should have been 100,000. This is backwards. Okay. So then the cost of goods sold is overstated. If then the cost of goods, the expense was overstated, that means net income is going to be understated. Ending inventory is going to be no effect. Liabilities is going to be overstated. If the liabilities are overstated, the working capital is going to be understated, and the current ratio would be understated as well. Turnover is understood. Wouldn't this be understated? Alright, give me a minute here. I'm gonna just double check some stuff, make sure I'm doing this correctly.